What happens to our investments if Schwab, Fidelity, or Vanguard collapse? Welcome to Invest Avenue, where we explore the world of investments and financial well-being. Today, we delve into a crucial question that concerns many investors: what happens to our investments if leading financial institutions like Schwab, Fidelity, or Vanguard were to collapse? As investors, it's essential to understand the potential implications and safeguards that exist to protect our hard-earned money. In this podcast, we will examine the possible scenarios and shed light on the measures in place to secure our investments. When we invest our money with established financial institutions like Schwab, Fidelity, or Vanguard, we entrust them with our funds for growth and security. However, the possibility of such giants collapsing may raise concerns about the fate of our investments. While it is highly unlikely that these institutions would suddenly vanish overnight, it's still crucial to explore the potential consequences and the safeguards that exist to mitigate the risks. Investor protection measures. In the United States, the Securities Investor Protection Corporation, SIPC, provides certain safeguards for investors if a brokerage firm fails. The SIPC acts as a safety net, covering up to $500,000 per customer for securities and cash, with a maximum of $250,000 for cash holdings. This coverage applies in cases where a brokerage firm fails and assets are missing due to theft or other unauthorized activities. It's important to note that the SIPC does not protect against losses due to market fluctuations or poor investment decisions. However, it does offer a safety net against the complete loss of investments in the event of a collapse or failure of a brokerage firm. Custodial arrangements. In addition to the protections offered by the SIPC, many financial institutions have custodial arrangements in place to safeguard investor assets. These arrangements ensure that client assets are held separately from the company's own assets, protecting them from creditors in the event of a bankruptcy or collapse. This means that even if the institution were to fail, investors' assets would be kept separate and accessible. Transfer of accounts. In the unlikely event of a collapse or failure of a financial institution, there are provisions in place to facilitate the transfer of investor accounts to other reputable firms. The regulatory authorities work to ensure a smooth transition and protect investors from unnecessary disruption. This process helps to ensure that investors can maintain control over their investments and continue managing their portfolios without significant interruption. Conclusion: while the collapse of leading financial institutions like Schwab, Fidelity, or Vanguard is highly improbable, it is essential for investors to understand the measures in place to protect their investments. The Securities Investor Protection Corporation, SIPC, provides a safety net, covering up to $500,000 per customer in the case of a brokerage firm's failure. Custodial arrangements and the ability to transfer accounts to other reputable firms further safeguard investor assets. Investing is an integral part of securing our financial future, and knowledge about the protections in place can provide peace of mind. By staying informed and working with reputable financial institutions, investors can navigate the markets with confidence, knowing that their investments are protected even in the unlikely event of a collapse. Remember, investing comes with inherent risks, but with proper knowledge and precautions, we can strive for long-term financial success. Thank you for joining us on Invest Avenue, where we explore the world of investments. Remember to stay informed, make wise investment choices, and always have a clear understanding of the protections available to you. Happy investing!